What's going on, everybody? Thank you for tuning in to another episode. And today we're going to be talking about new investor mistakes. And what made me come out with this video, because somebody reached out to me from a mistake that they made. Actually, a couple people. It ain't one person in particular. And I gave them what I would do, like I always do. I'm not a financial advisor. And everybody is different and everybody has different goals. So that's like a big mistake, is following what somebody else do. And the key to avoiding these mistakes, everybody that knows me know I'm a very I'm big on doing your own research. Okay, so let me say that I'm an avid reader. I like to read a lot, and I do my due diligence. Now, when I make a mistake, I want to know why I made my mistake. So with that said, we're gonna get right into it. I don't have a lot of time, and I know you don't have a lot of time, so let's just straight jump into this situation. It won't be no Captain Weenie, nothing going on today. If Captain Weenie doesn't understand what I'm saying today, that's just too bad, because to me this is simple. And basically, I have newcomers, new investors, and new traders coming at me all the time. It's not a mature audience when it comes to investing and trading, so I thought I would cater to you guys most definitely first. Okay, so let's get right into it. All right. So mistake number one is only buying hype stocks. What do I mean by hype stocks? Stocks that the news is always talking about, everybody always talking about, and you just feel like everybody else doing it, so I'm going to do it. The stock been going up. It's been going up 100, 200, 300%, and it's just a big thing, and you decide to put your money in it. Usually when that happens, by the time you put your money in it, it's too late. And even if it is too late, when that hype is over with and you still got your money in that company, get ready for timber, because the bigger they are, the harder they fall. Tesla is a good example of that. People was putting their money in Tesla, Bitcoin, Tesla, Bitcoin. And then they brag about how much money they make, but they don't tell you about the hit that they made. Same thing with marijuana stocks. Everybody was going crazy over marijuana stocks. I'm not a marijuana stock fan, because ain't no such thing as marijuana stock, because it's not federally regulated. You can have a publicly traded company that's investing in marijuana stock, a marijuana company privately, but that doesn't make them a marijuana stock. I can go on and on about that. You know, big hype. And then, but people not telling you, like Aurora that lost a lot of money. They'll tell you when they win, but they ain't gonna tell you when they lost their money. Okay, so mistake number two, selling on the first drop. So what happens is, let's say you got a company like Nike, right? They do really good. They've been doing good over the years, and then they do this incredible drop. They lose like 10% or 15%, and then you put your money in because you're like, it's going to go back up. Well, the thing is, you don't know when it's going to go back up. And if you're trying to make some money right away, then it might not never go back up. And the time you need to go back up, and then you stuck in this company, you stuck in Nike forever because you thought it was going to go back up just in a couple days or so. No, that's called trading. Okay, so if you plan on holding that for a long time, that's fine. But if you don't plan on holding that company for a long time and you think it's going to go back up because it did a big drop, then you're wrong. Okay, Wall Street will get you, trust me. Number three, not investing and reading in books. I love this one. Okay, if you're not reading about not reading, investing in books. So if you're not reading about day trading, if you're not reading about investing, and you're not really putting time in like you did in school, think about this. When you was in school, you spent 8 hours a day learning about what it is you want to do when you grow up. Whatever that is, I want to be a firefighter, I want to be a policeman, I want to be a doctor, I want to be a lawyer. You got to go to school for that, right? So for some reason, when it comes to Wall Street and investing and trading, people feel like they can watch a YouTube video and then they got it and they can do it. If it was that simple, I would be rich because I love Wall Street. It's what I do. And, I will be rich. Yeah, that's all I got to say about that. So you got to put in your due diligence. If you're not willing to put in an hour or two a day reading and doing research and finding out what's going on in the market and looking up definitions that I'll be posting on my videos, this just not for you. You know what I'm saying? Let a broker handle your business. Put your money in the fund and keep it moving. Keep adding to the fund. Just keep it moving, man. This ain't for you. All right. We on number 4, I believe. Buying based on dividend yields. There are a lot of companies that give you a lot of money in dividends, but if you look at their chart, they're constantly going down. That is a big mistake people made. I've made that mistake. Now, mind you, all these mistakes I've made before. So I'm not telling you nothing that I haven't done. So you want to a more quality stock. Quality stocks, they might pay less dividend, but you gotta look at that chart. Compare it to the S&P 500. Compare a stock's chart to NASDAQ. Compare a stock's chart to the Dow and find out what's going on, okay? All right, here we go. Copying a YouTuber's stock picks. Okay, notice I never tell you guys about stock picks. I always tell you what I'm doing at the time, but that's not a stock pick. That's just telling you what I'm doing at the time. I follow YouTubers that's does stock picks, and sometimes I'll do good, sometimes I'll do bad, but everybody trades and invests differently, and that's the thing. You don't know what work that YouTuber has put in to give you those stock picks. So don't get caught in a trap with that. You're going to have your own flavor. You're going to have your own style. Just like you can go to your job and you can get trained. Let's say you got a phone job and you can get trained on the phone, but eventually you're going to start talking to customers and you're going to have your own flavor. And it's not going to be so much how you was taught in the training. As long as you stay within regulation of the company, you'll be fine. It's the same thing with stocks. So someone's stock picks are not always good, okay? And you don't know what that person is doing when they pick those stocks. They might be in that company for 5 minutes. They might be in that company for 10 minutes. That might be in that company for 3 days. You don't know that. So, hey, and you at work 9 to 5, they might be a trader who got time to look at the computer, the whole time while they in that company, and you don't. I mean, that's just real. So, yeah, that's another mistake. Failing to diversify is another one. Yes. I just did a video. Go back and look at my last video on diversification. Diversification. You got a whole bunch of tech in your stock portfolio, and you don't have Procter and Gamble that makes toilet paper and toothpaste. You don't have Nike, which is a shoe company. You want your portfolio to be what's called equal weight. Okay, you don't want an overweight. Now I'm a little bit more advanced. I do have overweight in my portfolio as far as tech because I like it, but I also know how to trade, and also know how to get stocks at a good price. So you can't do what I do. You got to find out what your flavor is and what your situation is. My situation is different because I'm a day trader. I'm gonna keep saying that because I don't want nobody just doing exactly what I'm doing. You know what I mean? I don't give y'all enough information to do that anyway because I'm not a broker. I'm not a financial advisor, and I just tell you what I do, and that's all I can do. But yeah, that's a big thing. Okay, you want your stock portfolio to be diversified. Another one is trying to beat the market. You will never beat the market. You will never beat the market. Stop trying to beat the market. You don't know what this market gonna do. You don't know if it's gonna go up, down, sideways. You don't know. Stop trying to beat the market. It's not gonna happen. Now, certain stocks at certain times beat the market, but you should not base your investing and your trading on trying to beat the market. It's just not gonna happen. Trying to time the market. That's another thing. Trying to time the market will be a good example now. Everybody think the market gonna go up if Trump wins. Market gonna go down if Biden wins. Some people think that market gonna go up if Biden wins because he's gonna work out some deal with China. It's just a lot going on, man, and you don't know when the stock is gonna go up or the market is gonna go up or down. You just never know. So timing the market is just, I think it's gonna go up at this time. I think that Tesla is gonna go up at this time. You don't know that. A lot of people try to time the market on Tesla with battery day, and they end up losing 20% of their money. I fell short of that. The difference is I got my money back. Mistaking trading with investing. Mistaking trading with investing. This is a good one. Just because you put money in the stock, you make a few dollars and you pull out, does not make you a trader. You are not a trader, okay, at all, if you have not experienced some of the pitfalls that the actual day trader has experienced before. So you tell people I trade stocks. Not necessarily. Trading stocks is when you trade stocks continuously all the time, constantly making money, not when you just so happen to look at your phone on a lunch break and see that you made a couple dollars on this company and whatever. So stop getting those two mixed up. So let me tell you the difference between the two so you can understand. I can only tell you what I do. Investing for me is I invest in a company. If it gives me a substantial profit at the end of the year, I pull out. All right? Trading is when you buy a company and you sell a company in the same day. That's day trading. Swing trading is when you buy a company and you sell a company maybe a few days later. That's swing trading. Or even a month or 3 months later. That's swing trading. You can swing trade. That's cool. Okay? But just because you got money in a stock and you sell it does not make you a trader. Okay? It does not make you a trader. That's a consistent movement that a person is doing in order for them to be labeled as a trader. Now, investing for me is usually the stocks that I invest in, I hold, and I plan on holding for the rest of my life. I pick companies that I want to hold for the rest of my life that I'm gonna be able to pass down on my son, and he can pass it down to his generation. Yada 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 yada. Now at the end of the year, if something that I planned on investing in gives me a nice profit, I'm talking like doubles, I may pull out that company and put my money into another company. But this is the thing, I'm not gonna pull my money out of a company if I don't know where I'm going to put that money after I'm done selling off that stock. So in other words, if I put $100 in a company and at the end of the year it makes me $200, I'm not going to sell that company unless I have a great place that I know I'm going to make more money from that $200 once I sell it. I'm not going to do that, and I can turn that 2 to 4. I'm not going to do that because it's obvious that the company is good. So I'll leave it in my portfolio. Why would I sell that off? Especially if I'm getting dividends, and that's why I like stocks with dividends. Because if I put $100 into a company and that was $200 and it's giving me, let's say, 5%, and it's still giving me 5%, I'm not no longer making 5% off the $100 that I put in originally. Now I'm making 5% off the $200 because it's double. You see what I'm saying? So why would I sell that? So that's an investor. Okay, that's investing. Let's see what else we got. Picking the wrong broker. That's a good one. Picking the wrong broker. All right. So what do we mean by that? Well, Robinhood, cough, cough. Robinhood is for beginners. Okay. So I like brokers that have people you can call and talk to. I don't want to email and you get back with me in 3 days. So a lot of people get frustrated because they get with a company like Robinhood and they think they're an advanced trader. You can't be an advanced trader and not have that customer service feature. I'm just using Robinhood for example. Don't get it twisted. I like Robinhood. Robinhood is the bomb. I got Robinhood. But for a person like me, I can't deal with Robinhood because I need a customer service. I need somebody to talk to on at certain times. Okay. So picking the wrong broker could be them just simply not doing having the features that you want. It could be something like that. I mean, it could be a number of reasons of why, but you have to do your research to find out where you want to put your money to even invest or trade stocks is my point. Okay, but and the reason why I said Robinhood is because a lot of people feel like the Robinhood is the end all be all, and I just personally think it's not. Okay, I think it's good for beginners. I think it's good to teach kids with Robinhood. So that's another thing. And I will say, I'm gonna say it, bump it. I've had instances where brokerage houses were racist. You know what I mean? By the actions that they showed me. So that was not the right brokerage house for me. And I'm not gonna say their name. That's not important. But I've had that happen to me before. Let's see what else we got here. Over complicating investing. Oh my God, I'm bad. I do this myself. Over complicating investing. That's right. Just keep it simple, man. We know that Nike is a good company, right? And if you want to own some shares of Nike, go ahead and do that, man. Don't worry about what price it's at. Don't worry about that. Now, if you can get it at a good price and you plan on holding it forever, cool. But you trying to look at the PE ratio, you trying to look at the earnings per share, you trying to look at all these things, and you got 10 different stocks that you're doing your analyzation on, you like, oh my God, I don't know which one to pick. It's not that hard, man. Once you see that a company is quality and you're interested in it and it's got a good run and it's doing its thing and it's a well-established company, the accounting look good, the books look good, the fundamentals look good, do your thing, man, if you plan on holding that in your stock portfolio. Of course, you want to know what the future is in the company, but don't overcomplicate it to the point where you're trying to make this decision on whether or not you're going to invest and you're not sure, and you're looking at some great companies like Nike, Procter & Gamble, Walmart, you know what I mean? Like, come on, man. Like, seriously, don't overcomplicate it. Diversify your portfolio, get you 10 good stocks that solid companies that you are interested in, that's paying a nice dividend, that's the market cap is good, the books is good, and just keep it moving. You know what I mean? Keep it moving. Start there. Not accounting for fees. That's another thing. So I'm guilty of this as well. I didn't put my money in mutual funds. I didn't put my money in ETFs. And I've been a part of certain brokerage houses that had fees. You always want to look at the fees. With mutual funds, you want to see which ones got the lowest fee. No low fees, indo, outdo fees, all these little fees that the brokerage house charge you or the broker charge you that's managing the portfolio. Even the ETF got fees. You want to look at that. Sometimes we buy stuff and we get excited and we're like, oh yeah, no, I want to buy this. This is a good company, or this is a good ETF, or this is a good mutual fund, and this is a good brokerage house, but we don't look at the fees. Always ask fees. And this is why you need the right brokerage house, because you should be able to call them and they should be able to guide you and show you. If you don't understand how to look for fees, that's why you want to call your broker and ask them questions. That was one of the mistakes, is picking the wrong broker. If you have a broker that is hard to get in touch with that broker, then guess what? They're not going to be able to answer questions about fees, which fees will add up, man, over 10 years. Can you imagine having your money in a mutual fund and you done made money with it, but you found out later after you didn't pull the money out that they didn't just overtaxed you on fees, and you could have had your money in another mutual fund with less fees and made more money? That'd kind of be disappointing. So that's why it's important to talk to a financial advisor, and that's why it's important to pick the right broker. And part of picking the right broker is making sure you pick a broker that is interested in making you money and not interested in making them money. Ooh, that was epic what I just said. So you want to make sure that a broker is in your best interest and not their best interest. And part of that is you doing your own research. Okay. What else we got? Investing on margin is another mistake that a lot of people make. So, let's go back to Robinhood. They got this thing where you can buy more stocks than the money you have. You know what I mean? If you have $10,000, we're going to let you play with $30,000 and $40,000. Bad move. Bad move if you don't know what you're doing. If you don't see consistent profits in your investing and in your trading within a year time, then you should not be trading or investing with borrowed money. You should not be doing that, man. If you want to learn how to trade and you want to learn how to invest with your money and not Wall Street money, because that can come back and bite you in the later. Okay, so please don't do that. Trusting financial news. Last but not least, trusting financial news. I always tell you, usually when you hear about something on the news like CNBC, they like 3 or 6 months behind, or they giving you some type of 3 to 6 month projection on what the stock market is going to do, or what an ETF is going to do, or what a stock is going to do. And by that time, it's either too late or too early. So that's my take on it. Those are the mistakes that most new investors make. I'm going to holler at y'all. I love y'all. God bless y'all. Hold up enough of y'all time. Peace.